This is going to be one of the more advanced Monday morning videos we've done in this entire series. However, for those who stick around, I think you will learn a lot from this video. It covers one of my favorite chapters from the Macro Specialist Designation, where we cover the 10 habits of highly effective stock pickers. Now, I'm not going to cover all 10 in this video for two reasons. One, it would probably be like 40 minutes long, and I'm not going to make you sit here that long. And then number two, I got to save something for the full program. So I'm going to take 5 of the habits that I think are best utilized in a YouTube type video, and we're going to really zoom in. So this isn't everything that you're going to get for all of the habits in this particular chapter. If you do go on to take the full program, however, this will give you a little bit of taste of what these habits are. So if you are interested in learning all 10, I have a QR code here that will bring you straight to the website for the Macro Specialist Designation. Take a second, look through the program. If you think it's a good fit, highly suggest you move forward. It's awesome. Okay, so habit number 1 of highly effective stock pickers. They are macro aware. And so what people are sometimes surprised to find out is that almost 3/4 or 74% of long-term average equity returns are explained by macro forces, and they're not really explained by company-specific forces. So the overall market dynamics or the macro backdrop generally plays a bigger factor in movement of markets than company-specific factors. And so much time and energy is spent on those company-specific factors. So the business cycle and equities go hand in hand. I've shown similar charts like this one in previous videos, but I have the ISM Manufacturing Index here in blue. It's actually that in both charts. And you can see that it has a relationship with both things like equity markets as well as earnings revisions. There's so many market-based factors or market-based trends that move alongside macro indicators, in this case, a leading indicator like the ISM Manufacturing Index. So if you're able to understand the ISM Manufacturing Index, where it's going, how it's calculated, etc., that can give you a sense of what's going on in real markets. And now it can also help you make investment decisions. So again, I could have picked any different style or size. I could have done small cap versus large cap. Could have done high quality, low quality, high momentum, low momentum. Any number of factors or style characteristics here. I just did value versus growth. I felt that was probably the easiest for people to understand. The ISM Manufacturing Index, again, a leading indicator, has a relationship with the style cycle. So the style cycles often mirror trends in the business cycle. So this can help you make decisions if you understand the macro about how you might want to tilt your investment portfolio. Do you want to be more, do you want to have a higher percentage held in value? Do you want to have a higher percentage held in growth? It's these types of decisions that can be made if you do understand the macro. So habit number 1, they are macro aware. They have an understanding of the macro. They know how to interpret the macro, and they know how to utilize the macro to make investment decisions. Habit number 2, they use and pay attention to valuation. So here, what we've done, if you look at these 3 charts across the board, we've taken 3 really good investment factors in the S&P 1500. Starting on the left, we have high dividend yield. And what you see here is the bars. Both bars are going to be 12-month excess performance over the index. So companies with higher dividend yields have excess performance over their index. Same with buybacks in the middle. Right now, we're just focusing on the red sort of pillar. Companies with high buyback yields tend to outperform companies that do not. Same with profitability here. Companies with a high ROE yield tend to outperform companies within the same index that do not have it. And so what we did in the blue is we then added an attractive valuation factor. The specifics of that we'll talk about in a second. So if you combine high dividend yield and attractive valuation, again, what does attractive valuation mean? spoiler alert, that might be a habit that's coming up, you get even bigger outperformance of those names. Same with buyback yield, same with profitability. So stock pickers that can use valuation on top of the factors that they're already looking at can see improved results. So in some, you can take pretty good factors, like the three we listed here, and make them even better. Valuation also works on pretty average factors. So the y-axes here are a little bit different. But there's less outperformance here for these factors. So high asset turnover, high margins, high interest coverage. Apologies. There's some excess outperformance. However, when you take these factors and apply attractive valuation screen, you get companies that outperform even more. So you can use valuation on already good factors. You can use valuation on average factors, put a screen together, and what you'll get is even better companies, or a more zoomed in version of companies that are attractive based on the factors you're already looking at. So how do you do this? Well, that's what we teach in the Macro Specialist Designation. So how do you set up a screen for attractive valuation? We're going to talk about that in the next habit as a spoiler. But you might be sitting here in this video, okay, this all sounds good, but how do I do it? Well, we teach you the very specific methods that Francois Trahan has used throughout his career in our Macro Specialist Designation program. So again, I have the QR code here. Encourage you to scan it, check it out, and see if it's a good fit for you. So habit number 3, they use valuation properly. Okay, so it's not just enough to use valuation, because you can use valuation properly and improperly. So we're going to start here on the left, and I'm going to explain what I'm talking about. So the valuation works cross-sectionally, but not in a time series. So start with the red diamond that sort of represents present time. So all the way on the right of the x-axis, it's about a 15 in our hypothetical x-axis here. And so what the blue line represents is a hypothetical PE ratio of a company. So it's ebbing and flowing over time, along with the business cycle. There's multiple expansion, multiple contraction. And so what we see here, someone sitting at about time 15 and sees a PE of about 15, so 15, we'll look at that and say, hey, previously the PE of this company used to be 24, 25, whatever it was, just a few time periods ago. Valuations look really, really cheap here. However, when you zoom out, you see that, yes, last time valuations were this cheap, the company outperformed, right? It had multiple expansion from 15 up to about 25. That is true. However, if you go back further than that, if you caught it in a down cycle, the last time it was here, multiples continued to contract even more, right? In this hypothetical example. So you can't look within a time series relative to a stock's own history and determine whether or not something is cheap or expensive. Because one, multiples change for a reason. There's a reason why multiples expand and multiples contract. Part of that is cyclical, and part of that is a changing macro environment, and also potentially some changes at the company level. However, you don't necessarily know, as that moves up and down, whether we're about to go into a contractionary period or an expansionary period. That is, unless you're comparing it to their peers. So that's where valuation gets used properly. And this page is a little confusing. However, what we show on the right-hand side with the red here is valuation relative to history. And you see that there's no real relationship based on what a company's PE is compared to what its company's PE was in the short-term history and the long-term history. But what you do see here is that when you look at valuation relative to a peer group all at one time, so if a stock has an attractive valuation relative to its peers, or an expensive valuation relative to its peers, that has shown signs of generating outperformance. So here we show the 12-month excess performance again in the S&P 1500. So to some, because this habit is a little confusing, habit number 2 was they use valuation, but you have to use it appropriately. You cannot use valuation relative to a company's own multiple history. You have to use it at a period of time versus its peers. So looking at a stock's valuation relative to its peers improves the odds of outperformance. That leads us to habit 4. So we have seen that using valuation and using valuation properly can generate outperformance on top of already good factors. Quality does something similar. And what do we mean by quality? So you could really break it down to conservative reporting of financials and aggressive reporting of financials. There's any number of ways that companies could either be more conservative or more aggressive with their financial reporting. And frankly, the companies that tend to be more conservative with how they report things tend to outperform almost across the valuation spectrum. So what you see here on the left, we have conservative reporters outperform. Um, you'll see the x-axis is low PE and conservative, all the way to high PE and conservative. So in bucket 1, bucket 2, bucket 3, bucket 4 are the quintiles of PE. You can see outperformance um, regardless of evaluation. The only way you get to that period where it is negative is when it's already high PE. So if you have a high PE company who's conservative, you generally do not tend to see excess performance. But low PE, all the way to that fourth quintile, if they are a conservative reporter of their financials, you tend to generate outperformance. The opposite is true of regressive reporters. So they tend to perform poorly. So again, here we have low PE in aggressive, all the way to high PE in aggressive. Starting on the right, you see that high PE in aggressive has negative outperformance or underperforms. Here we're using the Russell 1000. Again, this works across indices for the most part. And we see here, I do call out the low PE and aggressive, and then the second quintile. These are where you could potentially get some of your traps, where they look cheap, but they aren't really. And you want to generally avoid value traps. And so here's another way that Quality Screen can enhance an array of valuation metrics. So similar to what you saw with valuations, book yield, dividend yield, sales yield, earnings yield, free cash flow yield, all really positive factors that lead to outperformance. If you add a quality factor or specifically a high quality factor on top of these already good factors, you generate even more alpha. And here, I just looked at some of the things that we look at for how companies keep up. So paying dividends, again, that's usually a good thing. However, if they're paying dividends based on bad earnings, or if they're paying dividends based on money they don't really have, that can be sort of viewed as bribing investors if they want to avoid cutting their dividends to appear like, they're growing their dividends, but it's really not coming from a good place. Buybacks, kind of the same thing, viewed really, really well. But if they're borrowing money to buy back their shares at unattractive valuations, that's pretty aggressive. Then as well as potential manipulation via their earnings quality. Finally, habit number 5, they identify and avoid red flags. So this has become increasingly important since the global financial crisis, which is what I show here. So the blue is pre-financial crisis, red is post-financial crisis. And what the x-axis shows is the number of the worst performers in the S&P 500. So if you had a basket of 0 of them, obviously there's going to be no contribution to performance, all the way up to if you had the 50 worst performers. And what you can see, regardless of the number, whether it's 1, 2, 3, all the way up to 30, 40, 50, the new normal in the post-global financial crisis shows that avoiding red flags is more important than ever because the negative names in the index are more negative and they're having a larger negative contribution to the index's performance. So if you're able to avoid these, what we call portfolio torpedoes, you'll be in a much better place than those who do not know how to do that. And so here, again, we go in much more depth on how to do this. But this is a chart here that just shows as you pick out specific negative factors. So we're starting with a good factor here, low PE. And again, that's going to be relative to peers and not relative to history. Um, but as investors remove problematic factors like low operating efficiency, and high capital intensity, then we add leverage, then we add bad debt coverage, et cetera, et cetera, et cetera. You see that the 12-month excess performance starts to rise. So if you're able to pick off, it's not just picking off the best companies and overweighting those. Avoiding the worst companies can sometimes lead to more outperformance than picking the best ones. And then so that wraps up habit number 5. If you can identify and avoid red flags, again, we teach you how to do this in the designation program in great detail. Again, so a little bit more advanced than the type of video I usually make. We went through 5 of the 10 habits of highly effective stock pickers. I hope you enjoyed the video. If you did, please subscribe to the channel, as well as check out the full Macro Specialist Designation program if you want to expand on what you learned today. I will see you here next Monday. Have a great week.